Hi, I'm Anson from Group M. Today we are going to talk about the Japan Bubbles 1989. Japan Bubbles is an unprecedented financial bubble of an enormous proportion, and the devastating impact was even called the lost decade. In order to further understanding the reason behind the bubbles, we will first look at the background such as the economy of the society and what reason that caused the burst of the bubbles. Then we will find out the similarity between the crises, like are there any common factors that occur in both crises. Finally, we will find the possible site for the next financial crisis. So let's get started now. After the oil crisis, Japan's economy declined, but in the process complete, the transformation of the economic models from product-oriented to technology-oriented. The combination of a weakened yen and a technology-oriented economy has made Japan's export competitive. Therefore, as you can see here, the GDP grew from almost negative 2% increase to over 4%. So next, let's talk about the Plaza Accord. Since the multiple outbreak of the dollar's crisis, the United States economic crisis, and the resolvable contradiction of the system itself, the United States emerged from the Bretton Woods. The inflation was rampant, and there was a trade deficit with Japan. After that, since the commitment to the Plaza Accord was accomplished, and Japan was encouraged to sell the US dollars, the dollars fell and the yen rose, so the Japan export market suffered.
It can be observed that the yen has appreciated a lot from 216 yen to 120 yen to the dollar. So Japan was facing two difficulties. One is the economic downturn. Because of the appreciation of yens, the exports are losing the competitiveness. And secondly is the stress of exchange rate. The dollar fell and the yen rose. And there was only one standard solution to solve this situation, which is to lower the interest rate. They can solve the situation one by stimulating the economy, and it can solve the situation two by releasing the stress of exchange rate. But simultaneously, it can bring the side effect, which is the inflation. Inflation means it can bring a lot of money into the market, but the money only invests in real estate and stock market. It is because of the downturn of exports. Nobody wants to invest in industrial entity. Simultaneously, the bond market was fully open. The companies found that it was more convenient to raise funds in bond market. But the banks had to meet the loan target which set by the government. So they were forced to lend money to those who with low credit rating. So the individuals and firms all together participated in the investment, and a estate bubble was formed.
And in 1899, the Japan government finally decided to raise the interest rate to stimulate the bubble. And Yasuo Simiano was the governor of the Bank of Japan at that time. He raised interest rate 3 times in just 8 months. And he made a drastic increase, the interest rate increasing from 2.5% to 6% in about 2 years, and resulting in a sudden tilting of the liquidity. And as shown in the figure, Japan's interest rate was 2.5% in 1989, but by 1990, Japan's annual interest rate had risen sharply to 6%. And the collapse of the bubble economy first started with the stock prices, because the stock market reacted fastest. And in 1899, the stock market fell in a hurry and fell from 36,000 points to 70,000 points within 2 years. And the response from the real estate side was slower and lasted for more than a year. But in 1991, the property market, led by Tokyo, began to plummet, and Japan's asset bubble began to burst across the board. And as can be seen in the figure, housing prices in Japan's 6 major cities has fallen sharply since 1991, and no one buys anymore. And the housing mortgage by the bank lose value, and the bank loans suddenly become bad loans, and the bubble bursts.
After understanding some causes of the lost decade, we can compare the lost decade with the 2008 financial crisis. While there are many similarities between the crises, there are 3 major similarities that can be concluded. The first is that the initiation of both crises were caused by bursting of real estate and stock price bubbles, which led to a balance sheet recession as about bubble burst. Next, there were similar detrimental factors worsening the crisis, such as unregulated lending and excessive leverage. Lastly, there were similar macroeconomic consequences, such as low growth in GDP, although there was a slight difference in the impact of GDP. There was also the main characteristics of low inflation and high unemployment rate. First, the asset bubble burst. In both the lost decade and the 2008 crisis, there were greatly inflated real estate and stock prices caused by excessive lending of banks. This caused a self-sustaining cycle as the lending led to an increase in price of asset and equity. However, when the bubble burst, the undercapitalized banks suddenly struggled to collect money and remain liquid as loans turned bad. There was also rapid acceleration of asset prices, overheated economic activity, and uncontained credit expansion at the start of the crisis. The burst of bubble resulted in the Nikkei index halving, as well as, and for the 2008 crisis, it decreased housing prices by 1/3 between 2006 to 2009. Next, there were similar exacerbating factors that worsened the crisis. In Japan's last decade, there were delays in recognizing problem loans and weak accounting practices and regulatory forbearance. This also occurred in the 2008 crisis, such as the regulation of subprime lending and mortgage-backed securities were too lax, such as the passing of legislation in 2000 that disallowed supervision and regulation for these securities. Next, there was a focus for short investors and borrowers on short-term profits, which led to increased risk-taking. Borrowers were borrowing large sums of money to invest in the housing market, but when the housing prices dropped, they became excessively leveraged and became negatively geared, and this excessive leveraging worsened the issue. Lastly, there were similar macroeconomic consequences. There was a stagnant GDP growth, which occurred in the long term for Japan's last decade. There was also decreased GDP growth for the 2008 crisis, but it mostly occurred in the short term. There was also low inflation and a high employment rate. The US lost 9 million jobs because of the 2008 financial crisis. This can be depicted in the two graphs shown. The two graphs show the real GDP per capita in the United States and Japan respectively. We can see that there was a shock in the United States GDP per capita in 2008. However, there was not a stagnation in the growth rate, and the US economy eventually recovered. However, starting from the 1990s in Japan, the growth rate became stagnant and the difference in trend became larger and larger. However, there was no significant plummet or drop in the GDP per capita. However, what is undeniable is that both countries entered a recession at the start of the crisis.
Now I will talk about the possible size of next financial crisis. We find two possible sizes here. We all know that high leverage level would be a cause of a financial crisis. High leverage level basically means high risk and high risk of default and liquidity problem, which lead to a crisis. To measure the leverage level, we can use the debt to equity ratio, the DE ratio. Here is a graph about average DE ratio in US among the market. We can see that from 2012 to 2020, average DE ratio lies in 90% to 100%, while this number in 2008, before the financial crisis, is just over 100%. After 2020, we experienced the COVID-19 pandemic. We can see that during the pandemic, DE ratio is decreased. In the post-pandemic, we can see an increase of DE ratio, but will the DE ratio recover to the pre-pandemic level or even further as a form of revenge growth? We don't know. However, if yes, it will able to lead to a crisis again.
First sign of a financial crisis is an asset and property bubble. In most economies, a significant portion of debt is linked with assets and properties. Common example would be housing mortgages. Abnormal changes in these markets could signify the formation of a bubble and impending financial crisis. When these bubbles pop, nominal property prices plummet and falls below that of mortgages. As a result, people choose to default their mortgages, leading to disaster in the financial sector, as can be seen in the US financial crisis back in 2008. People would also resort to cutting down on spending and consumption, leading to deflation, followed by an eventual stagnation in the economy, as seen in Japan's lost decade. As illustrated in the shown graphs, Hong Kong's housing prices have been on the rise the past 2 decades, multiplying by over 6 times, followed by stagnation and even decline after 2020. Furthermore, the outstanding value of mortgage loans in Hong Kong currently amounts to almost half of the GDP. If Hong Kong's housing prices suddenly plummet, a financial crisis is likely to break out.
So now we can conclude that there are many parallels between Japan's economic crisis and the 2008 financial crisis in the United States. During the both crises, excessively loose lending standard and inefficient real estate and stock market investment were prevalent, which caused the massive effect of bad bank loans. Bubble in assets and real estate are proved to be the indicator of the impending financial catastrophe. That is the unusually high levels of leverage. Also, monitoring abnormal market activities can help to predict such crises and prudent lending practice. And judicious allocation of aid funds are important to prevent support for zombie companies, which can mitigate further risk.